Hey, what's going on, everybody? It is Thursday, February 15th. If you go back to, you could go all the way back to my videos in September. And I said, actually, even before September, when I said as long as Congress came up with a continuing resolution by the end of the fiscal year, which was September 30th, the market would have a positive trend going into mid-October. We'd hit some volatility because there was a tax drain there. Then we would rise into mid-November when that would culminate in a quarterly interest payment. And that's actually what happened. And I said in mid-December, we would have a market correction based on another tax drain that was a quarterly corporate tax drain. And then it would, about the third week in December, the rally would resume and we would go up straight into February 15th. The only part of that didn't happen was that mid-December correction that I forecast based on a tax drain. And that's because there really wasn't much of a tax drain. And I went over that at the time, and I did express my surprise at the fact that there wasn't really a tax drain. It was very, very modest. And that was also at a time when the Fed started to signal that they were done with the rate hikes. And so that whole monetarist reaction kicked in. But I'm not going to make any excuses about it. I will say that the tax drain that I anticipated in mid-December, that really didn't come to fruition. But my call, my forecast, and again, this is all based on fiscal flows. I said the market would start to resume its bullish trend around the third week in December and rise into February 15th, which is, and I've been telling you guys this is the peak of the fiscal flows for this cycle and really the peak for the year. And I just want to clarify what I mean by that, because some people have asked me, like, what do you mean, like fiscal flows are going to drop? They're not going to drop as in, start to decline. It's just that at this time of year, the late February, early March period, you get an exceptional spike in the fiscal flows because you get a quarterly interest payment. You got IRS tax refunds that are coming in strong now. And so you get this period at this time of year where we see a really big spike in the leading fiscal flows, the leading spending flows. And then, it goes back down to its normal level, which, by the way, this year, the normal level is running 100 billion over last year. And last year, those leading flows were 7 trillion. So I keep saying, like, there's no way you can have a recession when the government is spending 7 trillion. And I went back, I've explained kind of like an historical analysis or an historical picture of how that spending has multiplied over the years. I mean, if you go back to George W. Bush presidency, the leading spending flow was something like 2.5 trillion. And then you got to, by the time you got to Trump, really by the time you got to Obama, that was around 4 trillion. By the time you got to Trump, it was like 4.5 to 5 trillion. And then we hit the pandemic, and then it zoomed way over 7 trillion, and it's been over 7 trillion since then. So we basically had like almost a threefold increase in those leading spending flows. Like, if you want to explain why we've had this ongoing bull market, and I'm sure if you try to explain this to your friends or your colleagues or anyone who is not really versed in MMT, or maybe doesn't listen to my channel or something like that, they're not going to understand it. I'm just going to tell you that flat out. And they're going to think like, if you tell them that, they're going to be like, what are you, crazy? That's such a terrible thing. The government's spending too much money. We have all this debt, blah, blah, blah. And that's how they're going to react to it. But you guys know, because I've been explaining this to you, pretty much forever since I've been doing these things, that those leading flows, and especially the fact that they have multiplied and the magnitude of those flows over the period of time that I mentioned, has increased exponentially, really. That has been a major, major support in the economy. It's been a major, major support in the stock market. And it's the reason why I can always say confidently, like I did going into 2023. Remember, at the end of 2022, when the forecast for recession was universal among economists, I was the one here saying that's not going to happen. As long as they raise the debt ceiling, I said unequivocally that is not going to happen. And of course, it did not happen. We had very strong economic growth in 2023. And I am saying unequivocally it's not going to happen this year because there's not going to be any cuts to the spending. Now, the one thing I am seeing, and the one thing that I've been explaining to you or mentioning to you, is the fact that the deficit, which is the net addition of financial assets to the economy, the deficit, while it's still on track to hit something like around 1.6 or 1.7 trillion, which is huge, and that's still a big, enormous transfer to the economy. It's actually going to be down a little bit compared to last year. So again, I'll revert to my swimming pool analogy. If the water was at the top of the pool last year, it's down a little tiny bit. Okay, it's not like a big, huge drain all the way down to the bottom of the pool like we saw when we went into 2022. The change from 2021 to 2022 was like a 1.7 trillion reduction in the deficit. That was an enormous drain of the swimming pool. Okay, the pool still had water in it, but the economy had to adjust to that enormous drain in the swimming pool. Right now, we're not talking about anything even close to that 1.7 trillion drain. We're talking about like a 20 billion. So, when you think of a 20 billion drain, even if it's a 50 billion drain, compared to a 1.7 or 1.6 trillion overall deficit, and again, I don't even like to use the word deficit. It's very misleading because it has negative connotations. I like to call it the net transfer of financial assets to the economy, from the government to the economy. That's going to be down 20 billion, even if it's down 50 billion. When you look at that against a 1.6 or a 1.7 trillion net transfer, it's not a lot, okay? It's not a lot. It's like a pimple on an elephant's back. It's no big deal. So I'm not really worried about that. And the thing to follow, not so much is the nominal change, which that's important if you're talking about a big, big drop, but more so the trend of what is going on with that trend, that year-over-year trend in those transfers. Are those transfers shrinking as a trend? Are they stable? Did they come down a little bit and then remain stable? Or are they going up? In the case of this year, they're not going up year over year, but they're not collapsing either. They're going down a teeny tiny little bit. So I'm not really that concerned, but I do pay attention to it over time. One of the things that's very interesting to me, first of all, I want to mention that I have, and you guys maybe have seen the same thing, and I know my subscribers, because I send this out almost every day, maybe sometimes a few times a day, and I even have subscribers who send it to me. And what I'm referring to is I have seen a big increase in people who are saying, the debt is unsustainable. And this is coming from the likes, of course, we've heard Jerome Powell say it, we hear Yellen say it, we hear Jamie Dimon saying it, Paul Tudor Jones, the man with three names, saying it. Not that he's any genius when it comes to economics. Today I saw that this guy, Fred Smith, who is the CEO or the chairman of FedEx, he's saying it. They're all saying it. Now, as I've explained to you, this understanding on their part, which is really a lack of understanding, that's where it emerges from. It comes from a lack of understanding of sovereign money, of the fact that what the debt actually is untaxed dollars that the non-governmental sector owns as part of our wealth. And it is not something that poses any kind of a danger at any time or at any level, okay? The danger is if policymakers actually try to take that, and that's the only way they could, bring down the debt. They would have to take that, whatever that number is, 32, 34 trillion, they would have to take that, or at least some of that, away. And I said in a previous video, remember what happened to the economy when they only shrank 1.7 trillion. I say only, that was a record reduction. As a matter of fact, Biden was cheering that. He was announcing that. He was saying we just had a record reduction in the deficit. And what happened? We had 2 quarters of negative economic growth. You didn't hear anything about that. But that's exactly a consequence of reducing that deficit. And that was 1.7 trillion. So I said, imagine if they tried to take away that 34 trillion, or even a tenth of that. 3.4 trillion would be twice the drain that we saw in 2022, which would put the economy in a deep recession for at least a year, if not longer. And if they tried to take away 25% or 50% of that, you would create a worldwide economic depression, which would probably become nearly impossible to escape from. It would be like, a black hole in space when scientists call the event horizon. If you go past a certain point, when you get close to that black hole, there's this point very close to the black hole, which scientists call the event horizon. If you cross that, there is no escape. Not even light can escape. The gravitational force is so enormous that everything gets sucked in. So there is an event horizon when we're talking about reducing the debt. And what scares me is that I have seen a preponderance now, much, much more than I have seen in the past, voices from people who are considered, successful or knowledgeable or experts in their field or whatever, talking about this, and they really have zero understanding. And they're proposing, or they're sounding an alarm when you shouldn't be sounding an alarm. So I'm a little bit worried about this. So far, there hasn't been any action politically, and that's what it would take. It would take an act by Congress, signed by the president, to say, we are going to take these steps, A, B, C, D, to reduce the debt. If that were to happen, and depending on the magnitude of those steps, we'd have to take action. But remember, I've said in the past that right now there are 5 pillars, 5 main spending items which support this high level of spending. And they're all basically non-discretionary. I mean, they happen automatically. One of them is not non-discretionary, but we treat it like a non-discretionary, and that's defense spending. Okay, so you have Social Security, you have Medicare, you have Medicaid, you have defense spending, and now since 2022, when the Fed started to raise interest rates, you have interest income transfers. That's non-discretionary as well. So those 5 things are just behind what is this ongoing, very, very large leading fiscal flow. And it's going to stay that way. So unless, they say we're going to cut Social Security, they did make some cuts to Medicaid. Medicaid outlays are down year over year. I got a nose itches. Little bit, small decline in that. I track that number. Medicare is up, Medicaid down a little bit. Social Security is way up. By the way, that's an interesting thing, and I'm going to talk about that in a second. So it's something to keep an eye on. With all these people now out there in public chiming about the danger that's being posed, the unsustainability of the debt, blah, 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 all this crap, which is total nonsense because they don't understand. That's a bad thing. And again, I'm going to repeat, bad beliefs are like a disease in the body. If you don't eradicate the disease, it could kill the body. And this is a bad belief system, this idea that the debt is unsustainable. Every time I hear that, I'm like, oh my God, here we go. And it's, again, it's just every day now we're hearing this. Every day we're hearing this over and over and over again. I was going to say something about Social Security, which is very interesting. I wasn't aware of this till recently. I was born in 1957. That's the so-called, those are the baby boomers. I didn't know that 1957 was the year of the most live births in the history of the United States. So people my age, I'm 66, I'll turn 67 in April. People my age, we're the ones receiving Social Security, and we hit the peak, okay? We hit the peak just recently, okay? And what's interesting, because you hear another thing that you hear that goes hand in hand with this, the debt is unsustainable, is that Social Security is going to go bankrupt, right? That's another garbage, ridiculous statement. But you hear that all the time too. And I don't know if they're going to take steps to rein that in, to raise taxes to quote unquote pay for it, which is bullshit, or to raise the retirement age, or to make cuts. I don't know, but that's another thing we got to pay attention to. But the irony is that the peak in Social Security recipients, like people like myself or around my age, from 1957 on, that the growth in Social Security might actually start to be slowing down. So think about this. Whereas Social Security is one of the bedrock, it is the bedrock of this powerful fiscal flow phenomenon that I've been talking about, right? I mean, it's huge. It's like 1.4 trillion, just that every year. That's the bedrock. That's the foundation. On top of that is, the other things I mentioned, defense, Medicare, Medicaid, blah, blah, blah. But if Social Security actually is peaking, first of all, wouldn't that be ironic? Because they're all talking about how we're going to pay for it. Meanwhile, it might be at the peak, given the fact, if you look at 1957 was the highest year of live births. So it's people like me now who are going on Social Security, and then the recipient rolls are going to start to trend down a little bit. And that is something, again, where I said that's a non-discretionary. They're not going to boost that up. Okay, if anything, that's going to start coming down on its own. Maybe starting, I saw a thing, a statistic saying that in 2025, which is next year, those Social Security flows are going to peak and they're going to start coming down. And that's like, you talk about like a tectonic shift. I mean, there's no other way to describe it. If that starts coming down, you know, all these people who for so long they've been predicting, you know, the market's going to crash, it's overvalued, it's, you know, it's irrational exuberance, it keeps going up, it shouldn't. They didn't understand all this time these powerful fiscal forces that were keeping it up, keeping it supported, keeping it elevated. But now, just think in 2025, and I don't know, I might be wrong on this, but I'm just thinking, if you start to take away some of that, okay? I like to use the swimming pool analogy, but let's use like a different analogy. Let's use like a reservoir that's slowly starting to dry up because whatever, climate change. We're in an area, let's say it was an area that used to be lush and received a lot of rainfall, but now it's beginning to turn more into a desert. And slowly but surely, the level of that reservoir starts to go down. Imagine in 2025, if we peak out, and then you're really talking about a long-term situation where the stock market just stagnates at best. Okay, long term, I'm talking like, look at what happened in Japan when it hit the peak in 1989. I mean, you know, it's just recently kind of crawling back there. It's been, you know, what is that, 35 years. I mean, think about that. I'm not saying that's exactly what's going to happen, but you know, I've been thinking about it, and man, that's a tectonic shift. That's something nobody is talking about. As a matter of fact, they're talking about the opposite, like how are we going to pay for Social Security? It's going to go broke. I mean, the distribution, the outlays might actually start to, and don't forget, you know, the elderly people, the baby boomers, we start dying off. Hopefully I go for, you know, a lot longer than where I am right now. But I'm just saying, you know, we're finite. Eventually, that bulge of 1957 births, we get older, we start dying off. So that's wild, man. I find that to be wild. You're talking about, like, I know a lot of people, I talk to people, one day the stock market's going to just go down and it's going to, yeah, that could be the thing when you think about it. Now, I'm not prepping for that right now, okay? But talk about preppers, man. They're all out there in the woods waiting for Armageddon. I mean, that could be the biggie, the peak in Social Security. Think about it. It's wild, man. Nobody's talking about that. Like, you always hear this stuff first right here with me. Nobody else. Anyway, that's it for today, folks. Don't forget, as I always say, go to my website, sign up for a 30-day. I'm going to be talking about this a lot, I think. Not that it's imminent. It's not imminent. But, again, nobody's talking about it. You're not hearing this anywhere else. And you're not going to hear this. Even if it happens, you're not going to hear it anywhere else because they're not going to be able to connect the dots. Just like they can't connect the dots right now with why, you know, they think Social Security is like hurting us because, like, how are we going to pay? Social Security is saving us. But when it starts to decline, tectonic shift. All right, that's it for today. See you tomorrow. Bye.